Okay, now we're debt free. It's time to take our cash flow engine and redirect that into the acquisition of income producing assets. Now my hope is that all this time that you were getting debt free and for all these months that you were working your way out, you were listening to our newsletter every 2 weeks and you were developing the type of income producing assets that you really wanted to acquire. But just to go over them briefly, we'll cover good options for you for income producing assets. The first, if we take a look at the pie chart, is to be an employee and continue as an employee. For most of us, this will be our approach. For me, I stayed this way until I was 47 years old, and it was only that time that I decided to move into the small business and business investor category. For most employees, you need to understand Ray's rules. Ray's rules are control the asset and control the leverage. And no matter which of these you're talking about, if you can't have a significant amount of control over the asset and if you can't control the leverage, you really might as well go to Las Vegas with your income producing assets. The fact of controlling means that you don't just put it in an investment where some external factor can totally control the value of it and the return to you. In other words, if it were in the stock market, something could happen anywhere over in China or Europe or anywhere and could adversely affect your investment. Also, your investment could be manipulated by large purchasers in the stock market. No one individual entity controls the stock market. There's no element of control there. Sure, you can make guesses, and sure, you can take intelligent guesses and do a lot of research, but there is no particular way you can control the stock market. If there were, it wouldn't be a free market enterprise. It would just be an elevator to the top for everybody, and nobody would take the elevator going down. So this goes contrary to a lot of the financial planners. This goes contrary to a lot of the investment community. But you have to remember the motive. Their motive is to sell you things, just to sell you investments, make commissions. That's what their motive is. And most of these people are just working for a salary. They don't have their own portfolio. Relatively few of them develop their own portfolio and actually know more about what they're talking about than an academic. So in any event, the people that are successful at the market are spending hours and hours and hours of research and are really trying to make the best bets they can. And I use the word bets on their future. The second is to control the leverage. Now, the leverage is the amount of financing that you have on the asset. You can actually, if you have control over the asset, you can actually put financing on it to leverage the amount of the investment that you are acquiring to produce income-producing assets. For example, if you were saving up to purchase a home, a rental home for $150,000, it would take quite a while for you to accumulate $150,000 to go out and purchase that home. However, with leveraging, you can get a reasonable and acceptable down payment, and a financial institution would give you something called a mortgage, and with that mortgage, you can actually put that whole $150,000 to work for you, even though you didn't have to save up the entire $150,000. Now, this sounds like a contradiction, but it is not a contradiction when it's an income-producing asset, because in this case, this is what you call good debt versus bad debt. Bad debt is debt to purchase an asset that doesn't put anything in your pocket. In other words, it's no cash flow asset. Whereas a good debt is leverage and debt that you would use to acquire an income-producing asset, and as long as you control the percentage of the leverage, then you can actually accelerate your financial success. Now, I'm not saying going out and get a 90% financing. I'm not saying anything like that. I'm saying no more than 80% financing. In a lot of cases, 50 or 60% financing. Another way to have leverage without having the additional risk would be to have other people doing this with you. In other words, a group of people going in as investors together. and acquiring this. So either way you look at it, the only way that you can really control leverage is if you have control of the asset. And that's a key factor here to maintaining a positive cash flow and acquiring income-producing assets. You need to have some control over the income-producing asset. So as an employee, you're pretty much limited to real estate rental type property or to something that you can more or less control in the way of like a high yield bond or something with an organization that you can basically control the risk factors involved so that no external person could make a stupid decision and all of a sudden make your income producing asset worthless or almost worthless. So this would be a good research tool for you to look at if you're employed. And we're not here to actually sell you anything. We're just here to give you basic advice and start your research path to move in this direction. So that's, for about 85% of people, that's pretty much the best way that you can accumulate some income producing assets.